Last week, we looked at a company that raised $75 billion and still lost money. This week, the opposite problem. Nvidia made $216 billion of revenue last fiscal year. Not market cap, revenue, up 65%. And it did it at a 71% gross margin for the year and 75% in the fourth quarter, which is a software margin on physical hardware that has to be manufactured, packaged, cooled, and shipped. 90% of that comes from one segment, and the customers buying it are, right now, funding teams to build their own replacements. So today, how Nvidia actually makes money, what has happened in the last few months, and the risks that don't make the highlight reel. Let's get into it. Quick intro if you're new. This is Introcorp by S. Every week I take one company apart, the business model, the latest news, the risks, in about 15 minutes. No hype, no red arrows. This is episode 4 of the US series. Each one stands alone, so order doesn't matter. The lens is half investor, half engineer. Numbers come from filings and primary reporting. But I also care how the machine works, because with Nvidia, the engineering is the moat. And if you only look at the income statement, you will misprice this company in both directions. If you missed last week, episode 3 was SpaceX. Link at the end. Here's the run of show. First, the business. Technically 2 segments, but really only one. Second, the data center engine, which is where all the money is. Third, the roadmap and the moat. Rubin, Feynman, and why CUDA matters more than any chip. Then the news, the record quarters, and the China situation, which went from 20% of data center revenue to 0. And finally, the risks. If you're only here for one section, make it the last 2. Numbers to anchor everything else. Fiscal 2026, $215.9 billion of revenue, up 65%. Of that, $193.7 billion is data center. So 90% of this company is AI infrastructure. The latest quarter, Q1 of fiscal 2027, reported the 20th of May 2026 was $81.6 billion, up 85% year-on-year and 20% sequentially, with data center revenue of $75.2 billion, up 92% or 92% of the total. For scale, that single quarter is more than Nvidia's entire fiscal 2024. Gross margin in that quarter was 74.9% on a GAAP basis. Roughly 85% share of the AI accelerator market, and a $4.77 trillion market value as of the 28th of July. One note on the calendar, Nvidia's fiscal year ends in late January, so fiscal 2026 actually covers most of calendar 2025, and Q1 of fiscal 2027 ended the 26th of April 2026. It trips people up constantly. Officially, Nvidia reports 2 segments, compute and networking, and graphics. That's not very useful, so let's use the market platforms instead. Data center, $193.7 billion, about 90% of the company. The latest quarter alone was $75.2 billion, up 92%. This is the business. Gaming, $16 billion. Once, this was the entire company. It is now under 8% of revenue. Still profitable, still growing about 40%, but it no longer moves the stock. Professional visualization and automotive, $3.2 billion and $2.4 billion. Small lines, but automotive is the one people underestimate. It rides robotics and autonomy. And software. This isn't the reported segment, which is exactly why people miss it. CUDA, CUDNN, TensorRT, NIM, 4 million developers. It generates almost no direct revenue, and it is the single most valuable asset the company owns. So, the honest description. Nvidia is a data center systems company that still happens to sell graphics cards. $9 in 10 come from AI infrastructure. Let's stay on data center because this is the whole earnings story. 15 billion in fiscal 2023, 47.5 in 2024, 115 in 2025, 194 in 2026, and the run has continued into fiscal 2027. That is not a growth curve. That's a step function that keeps stepping. The first quarter of fiscal 2027 alone, 75.2 billion, up 92% year-on-year and 21% sequentially. Now here's the part people miss. It isn't just GPUs anymore. Networking, NVLink, InfiniBand, Spectrum X went from 3.1 billion in a quarter to 8.2 billion. That's a top 50 semiconductor company hiding inside a line item. Why does networking matter so much? Because a modern AI cluster is not a box of chips. It's one machine the size of a room. Whoever controls the interconnect controls the rack. And if you control the rack, the customer isn't buying a chip from you, they're buying a building. Management's line through 2026 has been consistent. Cloud GPUs are sold out. Demand is ahead of supply. That's a nice problem, but hold on to it. It means the constraint is the supply chain, not the demand. And that comes back in the risk section. The product cadence. Until 2022, Nvidia shipped a new data center architecture roughly every 2 years. Ampere 2020, Hopper 2022. Then they broke it. Blackwell in 2024, Blackwell Ultra in 2025, Vera Rubin launched at GTC in March 2026 and in production from the mid-2026, with partner systems arriving in the second half of 2026, Rubin Ultra in the second half of 2027, Feynman in 2028 on TSMC's 1.6 nanometer process. 1 generation per year. Each step is roughly 2 to 3 times the compute of the last. Rubin is quoted at about 5 times the inference performance of Blackwell and about 50 petaflops of EP4 per GPU against 20 on Blackwell, on HBM4 memory. But the specs aren't the point. The cadence is the point. Jensen Huang made this explicit at GTC. Google, Amazon, and Microsoft refresh their in-house chips annually. If Nvidia shipped every 2 years, a custom accelerator would only ever have to beat a chip that was 18 months old. At an annual cadence, it has to beat something brand new every single year. That is the strategy. It's also the exposure. The market is pricing this cadence holding through 2028. Every generation depends on HBM4 supply, on TSMC advanced packaging, on liquid cooling. Nvidia owns none of those. One node slipping a quarter and the multiple compresses fast. Which brings us to the thing that actually protects the margin. This is the slide that matters. Nvidia's lead is usually described as they make the fastest chips. That's true, and it's not the moat. AMD makes fast chips. Google makes fast chips. The moat is CUDA. 15 plus years of libraries, compilers, kernels, and tooling. Over 4 million developers. PyTorch, TensorFlow, JAX, all optimized for Nvidia first and everyone else second. Think about what switching actually costs. It isn't a purchase order. It's rewriting years of code, retraining your engineers, revalidating every model, and accepting worse performance while you do it. That cost is measured in engineering years, not dollars per chip. And they keep extending it upward. NVLink and the rack scale systems push the same lock-in from one chip to the whole data hall. Huang's own framing on the Q4 call was that Grace Blackwell with NVLink is the king of inference. Notice that's a systems claim, not a chip claim. This is why gross margin was 71% for the fiscal 2026 year, and it has run near 75% in the most recent quarters, 74.9% in the first quarter of fiscal 2027. Hardware companies do not earn that. Software companies do. Nvidia is being paid a software margin because it is, functionally, selling a platform. If you only remember one thing from this episode, the chip lead is a few quarters. The software lead is a decade. Now the part of the story that has already gone wrong. China was once at least a fifth of Nvidia's data center revenue. In 2024, the company held about 95% of China's advanced AI chip market. By 2026, Huang has described that share as effectively zero. Not because demand disappeared, because it became illegal to sell. The sequence. Export controls in late 2022 banned the A100 and H100. Nvidia designs the A800 and H800 to sit under the threshold. Those get banned. It designs the H20. That gets banned too. Then, in December 2025, Washington said it would allow the more advanced H200 into China. And in January 2026, the Commerce Department's Export Control Bureau formalized case-by-case licensing, with the U.S. government taking a 25% cut of the sales and security conditions attached. And Jensen Huang confirmed at GTC in March 2026 that Nvidia had received licenses and could resume H200 sales. Even so, by July 2026, only minimal volumes had actually reached China, with Beijing telling domestic firms to pause orders and buy Chinese alternatives. So Nvidia's share of China's AI chip market is still effectively zero. Both governments are scrutinizing it. Meanwhile, Beijing is now considering export controls of its own on Chinese AI models and the chips that run them. That's the mirror image of the American policy, and it points at a genuinely bifurcated world. The lesson. This is a risk Nvidia cannot engineer around. It's political, and it moves faster than any product cycle. The prints that got us here. Q4 fiscal 2026. Reported in February. 68.1 billion, up 73% year on year. Data center 62.3 billion. GAAP gross margin 75%. Diluted EPS 176. Wang's line was, Blackwell sales are off the charts and cloud GPUs are sold out. Q1 fiscal 2027, reported on the 20th of May 2026. Record revenue of 81.6 billion, up 85% year on year and 20% sequentially. Data center 75.2 billion, up 92%. GAAP gross margin of 74.9%. GAAP diluted EPS of $2.39. Nvidia returned about $20 billion to shareholders in the quarter, added $80 billion of buyback authorization, and raised a quarterly dividend from 1 cent to 25 cents. Full year fiscal 2026, 215.9 billion, up 65%. 41.1 billion returned to shareholders through buybacks and dividends, with 58.5 billion still authorized. And the stock? About $197 a share on the 28th of July. A $4.77 trillion company, up roughly 13% over the year, and around 17% below its high. Here's the honest framing of the valuation debate. The forward multiple has kept falling. It now sits well below the 5-year average. On the numbers, Nvidia has actually got cheaper. Earnings grew faster than the price. Whether that's a bargain depends entirely on one question. How long does AI capital spending keep compounding? Nobody disagrees about the earnings. They disagree about the duration. Rapid fire on the recent run. The 28th of July, yesterday, Nvidia closed at $197.01, about 4.77 trillion, up roughly 13% over the past year, but still around 17% below its own high. The 27th, the Nvidia agreed to invest $5 billion in Ilya Sutskever's safe superintelligence, and under a long-term partnership between the two companies. The 24th, a report said Nvidia is in talks to help back OpenAI's lease of a $500 billion data center, part of roughly $750 billion of deals that have revived worries about circular financing across the AI industry. The 21st of July, Nvidia detailed its Vera CPU for AI servers, taking on AMD and Intel, and signed a $1.5 billion chip packaging agreement with Amkor. And the 20th of May, the first quarter fiscal 2027 results, a record $81.6 billion of revenue and $75.2 billion of data center revenue. Notice the pattern. The headlines are now as much about financing and partnerships as about policy or product. That's a change, and it's a tell about where the risk now lives. Demand, supply, concentration. 4 things. 1. Customer concentration. A handful of hyperscalers are most of the revenue. Nvidia's growth is not set by its own order book. It's set by 4 or 5 capital budgets. That's a very short list of people who need to keep saying yes. 2. The CapEx cycle. Hyperscalers are spending several $100 billion a year on AI infrastructure. That is the single largest infrastructure build-out happening anywhere. If it pauses, not reverses, just pauses, Nvidia feels it first because it sits at the front of the spend. 3. Supply choke points. HBM for memory, TSMC advanced packaging, liquid cooling. The annual cadence depends on all 3, and Nvidia controls none of them. Cloud GPUs are sold out sounds bullish, and it also means the ceiling is set by somebody else's factory. 4. China at 0. A fifth of data center revenue gone. And even though Washington reopened H200 sales in early 2026, almost nothing has actually shipped. So the contribution stays near 0, while Beijing keeps funding domestic alternatives like Huawei. None of these are fatal on their own. Together they explain why a company that grew 85% year-on-year last quarter still trades on a forward multiple near 20. The market is not pricing these numbers forever. Competition, regulation, valuation. Custom silicon is the big one. Google's TPUs, Amazon's Trainium, Microsoft's Maya, these are annual programs now, not experiments. Nvidia still holds roughly 85% of the AI accelerator market, and custom silicon has already taken measurable share. So every point the hyperscalers take comes straight out of it. And note the awkward part. The customers building them are Nvidia's largest customers. The merchant field. AMD's Instinct line is the first genuinely credible alternative, and open software stacks keep narrowing the practical CUDA gap. Not in 2026, but the gap is not fixed. Regulation, both directions. Washington decides what Nvidia may sell abroad. Beijing is now weighing what its own firms may export. Neither is in Nvidia's control, and neither follows an engineering timeline. And valuation. At about $4.8 trillion, the price assumes the annual cadence holds, and hyperscaler spending keeps compounding into the 2030s. One missed generation, one HBM4 yield problem reprices the entire story. For a decade, the bull case was simple. Nobody can catch them on silicon. That's probably still true, but the argument has moved to software, supply, and politics. And at this valuation, there's very little room for any of it. 3 things to take away. 1. Data center is the company. 90% of revenue, effectively all of the growth. If you own Nvidia, you don't own a chip company. You own the AI infrastructure build-out itself, with all the cyclicality that implies. 2. CUDA is the moat. The chip lead is a few quarters. The software lead is 15 years. That is what holds gross margin above 70%, and it's what a competitor actually has to beat. 3. The price assumes the cycle holds. At about $4.8 trillion, the market is underwriting an annual cadence and hyperscaler capex that keeps compounding. The forward multiple looks reasonable only if that continues. That's not a sell signal, it's the shape of what you're buying. If you missed last week, episode 3 was SpaceX, the $1.77 trillion bet riding on a single rocket. Good companion to this one, because it's the same question from the other end. What are you paying for an option on execution? If this was useful, subscribe. See you in the next one.